If you've been sitting on cash because you're waiting for the right time to invest, you're already losing money, and the math behind why might surprise you. Look, I get it. You just got a bonus, a tax refund, or maybe you finally saved up a chunk of money. And now everyone's telling you to spread it out, invest a little each month so you don't buy at the top. It sounds safe, right? Here's the thing. That strategy, called dollar cost averaging, loses to just putting it all in at once about 66% of the time, 2 out of every 3 times. That's not a close call. That's not a coin flip. That's the market telling you something most people don't want to hear. By the end of this video, you'll know exactly why waiting costs you, when it actually makes sense to spread out your investments, and what to do if you've got money sitting in your savings account right now earning basically nothing while inflation eats it alive. And this matters more than ever, because with rent up, groceries up, everything up, when you finally do save money, you can't afford to let it just sit there doing nothing. Let's break it down. All right, so lump sum investing means you take all your money and invest it today. Done. Dollar cost averaging means you take that same amount and spread it out, usually over 6 to 12 months, investing a little bit each week or month. The idea behind dollar cost averaging is that you're protecting yourself. If the market crashes right after you invest, at least you didn't put everything in at the peak. You're smoothing out the ups and downs. Sounds reasonable, but here's what most people miss. A study by Vanguard looked at historical market data from the US, the UK, and Australia going back decades. They compared lump sum investing to dollar cost averaging over 12-month periods, and lump sum won about 2/3 of the time. Why? Because markets go up more often than they go down. That's just how it works over time. So when you're sitting on cash, spreading it out month by month, you're basically betting that the market's going to drop. And statistically, that bet loses twice as often as it wins. Let's say you have $10,000 right now. If you invest it all today and the market goes up 8% this year, you made $800. But if you spread it out over 12 months, your average dollar was only invested for half the year. You're catching maybe half that growth. You just left money on the table. Okay, but what about that other 33% of the time? What if you do invest everything and the market tanks? Here's the hard truth. If the market crashes, dollar cost averaging doesn't save you. It just means you lose money slower. You're still losing. And if the market keeps going down for months, you're still buying all the way down. You don't avoid the pain. You just stretch it out. The real question is, are you investing for this year or for the next 10, 20, 30 years? Because if it's long term, a bad year doesn't matter. What matters is time in the market, not timing the market. Let me clarify something important. There are times when spreading it out is the right move, but not for the reasons people think. If putting all your money in at once is going to make you so anxious that you panic sell the first time it drops 10%, then yeah, spread it out. Your biggest enemy isn't a market dip. It's you pulling your money out at the worst possible time because you couldn't handle seeing red. Or if you literally don't have the cash yet, like you're getting paid every 2 weeks and you're investing part of each paycheck, that's not really dollar cost averaging by choice. That's just investing as you earn. That's fine. That's normal. But if you're sitting on money right now, fully saved, and you're just scared, the data says put it in. Here's what nobody talks about. While you're waiting, while you're spreading it out, that cash is losing value. Inflation's been running at 3, 4, 5% or more, depending on the year. Your savings account is paying, what, 0.5%? Maybe 4% if you're lucky with a high-yield account? So every month you wait, you're losing purchasing power. And if the market goes up during that time, you're losing twice, once to inflation, once to missing gains. The real problem starts when you're so focused on avoiding a loss that you guarantee a smaller one. So here's the bottom line. If you've got money ready to invest and your timeline is years, not months, the math says put it in now. You'll beat dollar cost averaging 2 out of 3 times. And even when you don't, the difference is usually small. But if seeing your account drop 15% is going to make you sell everything and never come back, then ease into it. Better to invest slowly than not at all. The market rewards people who show up and stay. It punishes people who try to outsmart it. Real security comes from understanding the rules, even when they feel uncomfortable. If this helped you think differently about investing, hit subscribe. I break down money topics like this every week. No hype, just the truth. Drop a comment if you've been sitting on cash or if you've already made the jump. I read all of them. See you in the next one.